What's up, everyone? It's Karthik with MoneyVest, and what an incredible day. Absolutely beautiful, with $2.9 trillion worth of value wiped out from the stocks globally this morning, just today. And this was the worst day in the stock market since the 2020 pandemic crash. And all markets across the board suffered. It wasn't just the US markets, Japanese markets, markets over in Europe. Everything was selling off across the board. Just a few sectors, few small pockets in the market, few stocks in the market that kind of held up really well. But the entirety of the markets here, more specifically technology, was in a complete bloodbath as it continues to sell off down to a correction for the S&P and the NASDAQ. So hope you all enjoy this video. We've got lots to discuss. We got lots to unpack in this entire update. It might be a bit of a longer one. So I really ask you to drop a like and share this video. So do me a favor, copy the link or share this video with other friends, other family members, other investors, other traders in your Discord groups, your WhatsApp channels, wherever you want, because I feel like this is going to be a very, very important update for all traders and investors. So do me a favor, spread the word. I would really appreciate that. It's word of mouth recommendations like these that help our channel and our community grow. So I would really appreciate that if you simply share this. So $2.9 trillion wiped out from the stocks this morning. I think the battle has begun between the bulls and the bears. We are now in a full-blown correction for the NASDAQ. The bears are starting to put a lot of pressure to the downside, but those bulls are also fighting hard intraday as they continue to kind of hold on to something, but the bears are certainly in full control, back in control, I should say, as we are seeing a pretty significant selling pressure here with the NASDAQ down over 2.5% on the day. We had the S&P 500 down almost 2%, and the Dow Jones is down over 1.5% on the day as well. If you come over to some of our index levels, so we've added this market snapshot, as you already know, we are in a dip for the S&P 500, so just got to make sure that we are indeed in a dip. So if you come over to the S&P 500 here, from its all-time highs of well over 56.69, so we are down over 5.6%. So those numbers on our platform need to get updated, so they will get updated at the end of the day once the markets officially close after hours as well. But we are down over 5.6% as of today's close. Now we are in a pullback for the S&P 500. The NASDAQ index, which is IXIC, you can see that it's down a little bit over 2.5% on the day, down over 10% officially in a correction. So as of this moment, S&P is in a pullback, NASDAQ composite is in a correction. The Dow Jones is very much still in a bit of a dip because it's only down under 4%. And if I bring over QQQs, which is the NASDAQ 100, it is also in a very nice correction, down over 10.7%. And these stocks over here across the board are somewhere between correction, pullback, and a bear market as well. Tesla was in a bit of a crash because it was down a little bit over 50% at one point. Right now, only down under 50% from its all-time highs. But the bottom line is we are seeing lots of selling pressure across the board for not only the indices, but also for technology stocks and for the entire market as well. So we had over 4,743 stocks declining on the day, with only 981 stocks pushing higher. And this right here, of course, was the entire day for Magnificent 7, including some of the other stocks here. So Amazon having its worst day, one of the worst days, down almost 9%. On the back of a revenue miss and slowdown in advertising revenue. Tesla down over 4%, coming down to low 200s again. The entire index, which is our FANGMANT index, so that's the Magnificent 7, down over 2.66% on the day here. Google was down over 2.3%. Microsoft was down over 2%. Meta was down almost 2%. Netflix was down over 1.85%. NVDA was down a lot more, and then of course it recovered a little bit to only be down 1.77. AMD and Apple were the only two stocks that kind of managed to eke out a gain. AMD just about flat, and Apple being seen as a bit of a safety trade. I think this is one of those stocks that gets a bit of a defensive trade inflow because most people want to sort of park out in Apple. They want to just kind of wait out in that stock, kind of hide in that stock until all the uncertainty is behind us, and then they move out, and then of course they start deploying elsewhere. But Apple is kind of like seeing a little bit of that inflow. Of course, Tim Cook also had a pretty decent call during the earnings that they reported yesterday after the markets closed. I'm down almost $12,000, so I participated in the sell-off that was there in the entire global markets dropping over $2.9 trillion. I made my contribution down almost $12,000 on the day, and this is where the Money Vest Index is trading at now, 3.28. This is a very, very incredible level. So we are now in the yellow zone. So if I bring over you guys to the Money Vest Index here, this number needs to get updated again. A lot of the updates happen on our platform and on TradingView towards the end of the day, but right now we're inside this yellow zone, so we are now sitting at 3.28. So we're right about here inside this yellow zone, and the lower we get down to, the better it is going to be, the better the buying opportunities, right? So links going to be down below if you want to join and be a part of our MoneyVest community. You get access to our daily readings on the MoneyVest Index, as well as all the members-only private videos, including all the trade alerts and the trade ideas, and my 37 stocks and ETFs shopping list, which is very useful right now because it goes over the 37 stocks and ETFs that I'm planning to buy with individual buy targets for light buys, heavy buys, and no-brainer buys, as well as fair values also included. So links going to be down below. We'd love to have you on board, and there is a 16% annual discount available as well. So this right here is where we are with the Money Vest Index at 3.28. As this number continues to come down, especially when it's sub 3, that's when I will be a lot more aggressive in dollar cost averaging and buying into the markets, and of course looking at tradable opportunities as well. So you definitely do not want to miss out, because this index, I'm not kidding, is very, very helpful in my decision making for when it comes to trading and investing. And it's also got a very, very high success rate because we have back tested this over the last 15 to 16 years, and the results have been very good. So you definitely don't want to miss out for when the Money Vest Index is below 3. That's where the risk reward is optimal. It's really, really good. And of course, that's going to be a buying opportunity for us. Let's talk about the VIX. Volatility here, breaching over 26 on the day. So if you come over to VIX here, we were at one point trading up to over 29 actually. So we were almost at 30 on the VIX, the highest level that we haven't seen since March of 2023. I mentioned this in our Discord in our previous videos as well. So volatility breaching 23. This was a little bit earlier. For the first time since October of 23, if we break 23.08, it would be the highest level in over 1 year, going back as far as March of 2023. We were in fact almost as much as 30 on the volatility, getting up to those levels, and that was clearly, by all means, a place, a level where we need to be dollar cost averaging. So there's just no excuses for that. Those are buying opportunities, without a doubt. For when the VIX is high, it is time to buy. And we've also got that on our spreadsheet. So you can see that we closed at 25.8. We are in the 83 percentile for volatility, right? So 83 percentile, we're somewhere between these two numbers here, because of course we were trading up to as much as 25, 26. So we're in the 83 to 84 percentile at the moment. And once again, the higher we go, the more rare it becomes for the volatility to be there. And the higher the likelihood that the markets are going to reverse and of course go back up, and there's going to be some type of a technical rebound, because that selling pressure is going to eventually exhaust, and we're going to see that reversal back into the market. So it's really, really important for when these indicators align themselves, when the VIX is high, when the Money Vest Index is low, when you are seeing a lot of weakness, a lot of oversold conditions in the market, take advantage. Even if that means just taking advantage a little bit. I'm not saying to go all in and be aggressive. Take advantage, even if that means just dollar cost averaging just a little bit, so you don't feel like you're missing out on this buying window, right? You're not missing out on these buying opportunities. So this was the heat map for the entire market. Apple, for obviously pushing up 1.8%, as I mentioned earlier. UNH also pushing up over 2.6%. And of course, other stocks here selling off quite aggressively. Unemployment numbers came out, so I did a video on unemployment numbers earlier today, so make sure that you do check that out. But the bottom line is, we did see 114,000 jobs added in the month of July, with the unemployment rate, of course, increasing to 4.3%. And this right here is the overall unemployment rate, accelerating a little bit to 4.3. I broke down this number in my spreadsheet as well in my previous video, so definitely do check that out. But if you come over to unemployed persons, we have now cracked above the 7 million mark, which is quite aggressive. The last time we were at these levels was back in October of 2021. So it's been well over 3 years. In fact, almost 3 years that we've gotten up to over 7 million people in the US unemployed. And right now we're sitting at 7.1 million. Most of the jobs that were lost, they were lost in information technology, so IT, as well as financial services. So if you come over to, changes in employment by industry, you'll notice that information technology saw almost 3,000 jobs lost, and financial services also saw about 9,241 total employed, and down 4,000 here on a month-over-month basis. Information sector, in fact, had almost 20,000 layoffs and job losses in that particular sector. So that, again, kind of represents that artificial intelligence definitely is playing a bigger and bigger role. Intel also announced a significant amount of layoffs, I think over 15,000 jobs that they're laying off, and we'll touch base on Intel shortly. But this was the entirety of the breakdown of the jobs report, coming in a little bit hotter than what the expectations were, and of course flipping expectations on interest rates. Originally, the markets were pricing in for only a 25 basis point cut in the September meeting, and now the markets are pricing in for a jumbo 50 basis point cut. There is a 71.5% probability that the Federal Reserve is going to give us a double cut in September of 50 basis points and getting rates down to 4.75 and 5%. And then another 50 basis point cut is expected for us to come down to 4.25 to 4.5%. That's a 48% probability. That's going to be on my birthday. We'll see what happens on my birthday on November 7th. And expectations are that interest rates are eventually, by the end of this year, are going to be sitting at 4 to 4.25%. Markets are very optimistic, expecting about 125 basis worth of cuts from the Federal Reserve. So that's going to be 2 cuts in the September meeting, another 2 cuts in the November meeting, and then another 25 basis point cut in the December meeting. So 50, 50, 25, those are the 3 rate cut expectations from the market, which is quite aggressive. And this has only changed after the unemployment report from today. This has only changed after we got the unemployment print from today. Civilian unemployment increasing to over 7 million, unemployment rate increasing to over 4.3%. That certainly shows that we are seeing some significant weakness in the labor market, and as a result, the markets are now very, very aggressively optimistic on rate cut expectations. So this right here, already I went over. This is the interest rate expectations here, and the SAM rule is officially triggered. Now, this right here is a rule which was created by Claudia Sam, who designed the rule. And essentially what this rule is a sort of like a early indicator of a recession. And this essentially tracks the increase in unemployment rate compared to its last 12 months worth of low. So basically, what this means is that it's designed to signal a start of a recession, which has officially been triggered. So we have now officially triggered the SAM rule, which is a recession signal. So in other words, the start of a recession is officially here because of this SAM rule getting triggered, and it reached 0.5% after the July unemployment report, as in the 3-month average, moving average of the unemployment rate is now 0.3% above the low of the last 12 months. So this right here is the entire SAM rule triggers. And what you'll notice is that every single time the SAM rule has triggered, there's been a recession that followed, right? Whether it's 2 months prior, 4 months prior, 8 months prior, 1 month prior, 2 months prior, for when the SAM rule was triggered, a recession happened, right? So it coincides with a recession, dates when SAM indicator triggered, U.S. unemployment rate and recession also accelerated to the upside. And we just saw the SAM rule trigger as of August 2024, based on the report, the unemployment report that we got for the last month of July of 2024. So it could be anywhere from a month to as many as 8 months for when the recession actually begins. Is this time going to be any different? I doubt it. I mentioned this in my yesterday's video that the odds of us seeing a recession are accelerating very much. The November election is going to be very, very critical for the United States. And if we go into a recession, depending on who that party is going to be in the office, or whoever that president is going to have their work cut out for them, because they are going to be handed over an economy which is most likely going to be entering a recession fairly soon. So there's going to be definitely there's going to be a lot of political pressure, a lot of pressure in general on Jerome Powell, on FOMC to cut interest rates as fast as possible and as aggressively as possible. So this is kind of like shaping up to a known quantitative easing event coming up in the future. But we also want to make sure that inflation does not go crazy, does not accelerate back up, and it does not get out of hand, because we just spent the last 24 to 30 months fighting inflation, bringing it back down closer and closer to 2 to 3%. The last thing the economy wants, the last thing the Federal Reserve wants, is for inflation to accelerate back up on the back of interest rate cuts, because markets are very aggressive on interest rate cuts, 125 basis points. Recession indicators are also signaling for a start of a recession, which could happen in the future. So it's going to be quite an interesting next 6 months, everyone, because there's going to be tides sort of clashing on each other with respect to inflation, interest rates, and unemployment. Everything's going to be tangled up pretty badly in the next 6 months, I feel. So it's going to get quite interesting. I don't have all the answers, but it's going to sure be very, very interesting. Now, Claudia Sam herself, who designed the rule, has said the Fed should have cut rates on Wednesday, and she herself told the Wall Street Journal that she doesn't think the economy is on the immediate cusp of a recession, but the situation is getting worse. So that, I think, is somewhat I agree with, because we're not on the cusp of a recession right now, but the situation is getting worse. And I mentioned this in my previous videos, that we are seeing an acceleration in the unemployment rate, right? So it's certainly accelerating to the upside when it comes to the unemployment rate here. So this is what I mentioned to all the members in the community today. Markets positioning is very, very defensive. So that's very obvious. The markets are essentially getting risk averse. They're selling off all equities, small caps, big caps, doesn't matter what it is. They're selling and they're moving into bonds. They're moving into stocks like Apple, which are extremely liquid, extremely safe, with plenty of cash on the balance sheet. So that's kind of like a safe haven for the markets, moving into some of the safer side, safer sectors like fixed income, very, very safe. Apple, very, very safe. So that's markets' way of telling us they are getting very defensive, and those are the reasons why. Geopolitical risk, as we already know, we got recession risk, as I just went over, unemployment accelerated, as I just went over, and flight to quality, liquidity moving from stocks to bonds. The call to action right now: sit tight, be patient, gather cash, deploy slowly, let the prices come to you, and DCA and sell cash secured puts if and when you find those opportunities. I also mentioned, which is very important, this pullback could turn into a correction, which could turn into a bear market if there is a recession accompanied with these rate cuts, which we obviously don't know if there's going to be a recession or not. But remember that recessions and bear markets are best times to buy, not sell. Remember that. I think it's really important for me to re-emphasize and reiterate this message, that recessions and bear markets are the best times to buy and not sell. So don't get panicked. Don't be afraid of these market sell-offs. We literally just came off of an all-time high. We literally just came off of technology stocks doing incredibly well. Let the markets cool off a little bit. This is just a market cycle. It's happened before. We're going through this again. Just relax, okay? We've got a whole community of investors, experienced people in our community that are here to help you along the way. And I'm sure it's going to be super useful if you were to participate. Tom Lee also said something very similar. He tweeted earlier saying that, did the outlook for stocks suddenly become bearish yesterday? No. 4 reasons why this is ultimately a buying opportunity, right? And this was exactly word for word, not exactly word for word, but the same messaging to one of my videos that I mentioned, that what exactly happened between July 2nd and now. Why are stocks selling off so aggressively? What was the catalyst? Nothing, right? There was nothing really a catalyst. Nothing really happened that all of a sudden made everyone bearish on stocks. It's simply profit taking. We were overbought, overheated. So we're seeing a bit of a cool off period here. And again, the markets just need a reason to sell stocks. And right now they're getting more fearful of a potential recession. And that's why everybody is parking cash into more safer assets like fixed income and bonds than as opposed to equities. Did the outlook for stocks suddenly become bearish yesterday? No, this is why this is a buying opportunity. And then, of course, he finally said that overreaction to July is a report miss. Soft jobs report still supports soft landing and gives Fed room for cuts. VIX surging 50% to 28 means panic, and short-term means sellers will be pressuring the markets. And the July report, of course, coming in with a miss of 114,000 jobs added versus 175,000 jobs expected. So again, talking about volatility, talking about how this is a buying opportunity for the market. And Dan Ives also on the same page. We are getting inbounds from investors around the world asking us if this tech bull market and historic run for tech stocks is over. It's not in our view, and this is just white knuckle moment in a multi-year bull run for tech stocks that need hand holding. And I kid you not, there's been a lot of people that have reached out to me as well, asking for an analysis, recommendation, understanding, because there's a lot of fear in the market. And that's why we do these videos. That's why we are here to help you support. Like, this is literally why we've created the Discord channel in our community, is because I kid you not, we've got a lot of really experienced folks in our community, years worth of experience. Some people even worked at the New York Stock Exchange, the trading floor, managing multiple millions of dollars worth of portfolios. So we've been in this multiple times. If you're a beginner investor, we totally understand how you might be feeling, but our community members are here to help you. And this is just part of investing, right? You can't expect the markets to go up forever. There's going to be cycles. There's going to be pullbacks and corrections along the way. And the AI revolution story is well intact. And Wedbush, Dan Ives, easing investor fears about the potential for a bubble burst after Apple's impressive second quarter earnings. And he also mentioned that this is not the time to panic. Very, very good sort of messaging from both Tom Lee and Dan Ives. This is not the time to panic on the tech trade. It's a time to go bargain hunting for our top tech names after this panic sell-off, right? So the AI revolution story is well intact here. Mortgage rates also plunging to the lowest level in over a year after a weak employment report. So that's good for home buyers because the cost of mortgages are coming down. And the average 30-year fixed mortgage rate dropped 22 basis points to 6.4%. And the 15-year fixed rate fell to under 6%, lowest level since early May 2023. I just emailed my mortgage brokers to give me a new quote on the DSCR loan products that they've quoted me on. They quoted me as much as 8% just a couple months ago. And as we are expecting rates to come down, I'm getting ready to buy my first property over in the US as well. So that is going to be possible now as interest rates continue to come down. But then again, you're going to see a bidding war once again as it becomes a more of a buyer's market as interest rates come down and cost of borrowing continues to decelerate. And there's going to be more and more people interested in buying homes once again. It's potentially going to push prices even higher. Now, between Powell's equivocal openness to multiple cuts in 2024 on Wednesday and this morning's sharply weaker jobs report, the more aggressive rate cut narrative is quickly becoming into focus. And then reading further, Intel obviously having its worst day on Wall Street in over 50 years. 50 years, falls to the lowest price in over a decade. And the stock plummeted 27%. Intel, again, had one of the worst days on Wall Street and falling down to just under $22 a share. It would be the second worst day for the shares ever, behind a 31% drop in July 1974, which was 3 years after Intel's IPO. The company market cap is now under $100 billion. They swung to a $1.6 billion net loss after reporting net income of just under $1.5 billion last year, and earnings per share coming in 2 cents per share versus estimates of 10 cents per share for the company as well. Intel also said that it won't be paying a dividend in the fiscal fourth quarter 2024, and it also lowered its full-year capital expenditures by over 20%. And the company said it would be laying off 15% of its employees as part of a $10 billion cost reduction program. I'm sure by now you know that there was a Reddit post from a individual who inherited about $800,000 from their grandmother before she passed on. That $800,000 inheritance, he put in $100,000 into a savings account and $700,000 into Intel stock when it was at closer to $30. Wall Street bets. Absolutely incredible. But he did have a pretty solid thesis. I'm not gonna lie. I mean, when I read this, he did do his research. Gotta give him credit where credit is due. He did do his research. He did put out a nice sort of bullet points, and he could very well be right over the long term, right? But in the short term, that's a very, very significant loss to stomach if you are just getting started in investing, because this person is a junior in college, math major, doesn't have a lot of experience investing, doesn't have any debt, so that's good. But that's still a pretty big unrealized loss to stomach through, especially when when that's inheritance money that you just received from your grandmother. But he did have a pretty solid thesis. So props to him. But long term, I feel like there may still just be a potential in this company. You can read this at your own time, but just wanted to share this interesting story with all of you. Now, when everyone is interested in buying, when I am here very vocal about buying, when Dan Ives is very vocal about buying, Tom Lee is vocal about buying, we've got our Cathie Wood selling stock, not just any stock, Palantir, Robinhood, Zoom, selling them very aggressively, and buying Moderna, buying CRISPR Therapeutics, so moving more towards healthcare and biotech, getting rid of Palantir, over 325,000 shares sold as of August 1st to buy Moderna. Very interesting. Tesla. So this right here was the tweet from James Stephenson. These are cumulative revenues for Tesla, to which Elon Musk essentially mentioned that long term, it will be super nutty. Tesla has broken their all-time quarterly revenue record 25 times over the past 10 years, including the most recent quarter and twice last year, to which Elon Musk simply said, it will be super nutty long term. So we'll find out what that's going to mean and be. Nikkei, absolutely brutal, down almost 5%. So the Japanese stock index going through an even worse time than the S&P or the NASDAQ. 3 back-to-back weeks for the Nikkei, selling off from its all-time highs of 42,000, which we recently hit back in July, to now sitting at under 35,000 for the Nikkei. So this has been an incredible selling pressure. What started off as a nasty drop in Japanese stocks on Thursday turned into a full-blown rout on Friday as the Topix posted its biggest two-day decline since 2011 tsunami, and the stark turnaround from the record high set in July when Japanese equities were being celebrated as one of the world's best performing markets. It sank 6.1% after the Bank of Japan's earlier than expected rate hike on Wednesday and Governor Kazuo Ueda's hawkish messaging. And a lot of people mentioned that I didn't expect the stocks to fall this much. It's a disaster. This was Kyushi Ishigane, Chief Fund Manager at Mitsubishi UFJ Asset Management. And Kai Rada also mentioned, in short, it's mostly the yen hitting, essentially coming down compared to the US dollar. And one of the main drivers of market's ascent, foreign investors sold net 1.56 trillion yen, or $10.4 billion of Japanese cash equities and futures combined in the week that ended in July 26. So Japanese stocks definitely struggling quite aggressively, including European stocks down over 2.8%, lower than extended losses after weaker than expected U.S. jobs report. So U.S. recession does indeed mean bad for the world as well, because U.S. powers 25 to 27% of the global GDP. And if the U.S. enters into a recession, it's going to be quite brutal for a lot of other world economies, including Europe, including Asia, including the Middle East. Just a lot of trading partners are going to be in a bit of a painful environment. The Thursday's decision, which was British Central Bank, brought down their rates by 25 basis points from 5.25% and to 5%. And Governor Andrew Bailey told CNBC that direction for interest rates was pretty clear, but he would not comment on the extent or timing of further cuts, and said services, inflation, and wage data would be watched closely. Market pricing in suggests expectations for rate hold in September, followed by another trim in November. So I believe that Jerome Powell and the FOMC over in the US is probably one of the only central banks right now left to cut interest rates. We know that ECB has done it, Christine Lagarde, Andrew Bailey's done it. Japan is actually increasing interest rates, but I believe China reduced interest rates. But this right here is the entire world, and it was a brutal day for the entire world, not just for the US, but for the entire global indices here. And again, a lot of the money flowing into bond market, again, inverse ETFs, including SQQQs, SOXS, TZA, so small caps, semiconductors, NASDAQ, everything inverse was pushing higher, and a lot of the momentum moving more towards TLT, TMF, kind of like those bond market ETFs pushing higher on the day. So coming back over to the charts now, volatility here, 26% higher, traded as much as 30. So as I said, when the VIX is high, it's time to buy. So we'll continue the dollar cost average into the market. QQQs here settled in at around inside this green rectangle. So we didn't quite see accelerated selling, but more like a sideways consolidation for the NASDAQ after selling off, after gapping down pretty much on the back of those earnings and accelerated selling pressure from the back of those jobs report, still within the context of this lower high and lower low. So we just printed a new lower low here for QQQ. So we're still very much in the context of this downtrend for the markets at the moment. So if I were to essentially point to this downtrend, so we started here, lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. So that is the overall downtrend for QQQs. SPY almost identical to what we are witnessing, S&P 500, so SPX. And this right here is the new lower low for S&P 500 as well. So that was the beginning, and this right here is the downtrend for S&P 500. So lower high, lower low, lower high, lower low, lower high. Not quite a lower high. This is actually one of the turning points where we believed that there's going to be some potential reversal here, and then selling pressure quite aggressively last couple of days here, selling off to a new lower low for S&P. Resistance is going to stay put at 5,400 now for the S&P 500. So that right there is going to be that level to keep in mind, with a very, very strong support at 5,300 for S&P 500. And NASDAQ here, we're going to be watching closer to support at around 16,005 and a resistance all the way up to 17,000 for the NASDAQ as well. Coming over to Apple, and Apple here selling off intraday. So 30-minute time frame, actually it's down a little bit over, it was 1.26% lower on the 30-minute time frame, but this right here is the entire sort of chart. It was making lower highs and lower lows, but still managed to close green on the day. Support level is going to stay put at 215. So if you come over to the 30-minute time frame, so that is going to be that support at around $215, and a resistance all the way back up to 227, and then another resistance to keep in mind at $220 for Apple. Amazon, very, very brutal. Did get bought up just a little bit intraday, so support level is going to stay put right over here at 166 for Amazon, all the way up to a resistance of 173 for Amazon as well. We're still, I would say, within the context of a potential, we were in a potential of head and shoulders, and then we finally got a break down below this neckline. However, green candle on a red day suggesting there were some buyers stepping in. This is going to be that support level, resistance all the way up to 173, 174 for Amazon once again. I'll be doing a video on Tesla very soon. It seems to be breaking down below $208, which is not good. We are seeing some selling pressure here on Tesla, so starting to break down even further. Next area of demand and support is going to be staying put at 193, 194. So that is going to be that level to keep in mind, and a resistance and targets back up to 233 for Tesla at the moment. Talking about NVIDIA, by the way, I will be doing a video on Tesla here in more detail. NVIDIA down over 1.7%, but got bought up here intraday. Support level at $96, $97. So this right here is going to be that level to keep in mind, with a resistance all the way up to as much as 118 to as much as 139, 140 for NVIDIA. So we were seeing, again, some lower highs and some lower lows. So this is a lower low for NVIDIA. So very much in a bit of a downtrend. NVIDIA is also at the moment. Talking about advanced micro devices and AMD, selling off here, of course, flat on the day, after hours pushing up just a little bit. And this right here is the analysis where it's coming down to that support at closer to $130 and resistance all the way up to 150 for advanced micro devices. So very, very oversold. As you can see, the RSI, MACD, L3 banker oscillator, everything selling off quite aggressively. And there is potential for a bit of a technical rebound for AMD, in my opinion. Talking about PayPal, and PayPal here also selling off, down over 5%. PayPal doing PayPal things and selling off quite aggressively. And again, there's massive area of supply and resistance at around $68, $69 for PayPal. Support level is going to stay put at $57 per share for this stock. Once again, we're back inside this green rectangle, this area of consolidation. We haven't really moved out of this level from November of 2023. We've just been consolidating sideways in between that range for PayPal. Visa, on the other hand, coming up to its resistance again. That's going to be sitting roughly at 267. That's going to be that level to keep in mind as a resistance, still within the context of a downtrend, so lower highs and lower lows over here. Support level is going to stay put roughly at 250, and a resistance, as mentioned before, at 266 for Visa. Coming over to Meta platforms, and Meta here, just very much a doji candle, so lots of consolidation sideways, down almost 2%, and this is very, very clear support and resistance areas for Meta. Inside this green rectangle is where the support and the demand is at 420, and resistance all the way up to $540 inside this area of supply and this red rectangle for Meta. Talking about Google, I believe Google and Microsoft are both trading at very good levels to dollar cost average into. In fact, even Meta, I would argue, even Amazon, I would argue, even NVDA, I would argue. There's a lot of companies now that are trading at very good nibble/light buy targets. So I will continue to kind of hammer on that point in our Discord to take advantage dollar cost average when you are finding those opportunities, when you're finding good deals, or just straight up sell CSPs. If you are not really interested in buying at these levels, you can sell a little bit further out of the money, cash secured puts, wait, collect some premiums while you wait for the stock prices to come to you. Again, that's the whole idea. Let the prices come to you. Google here, support level inside this green rectangle, sitting in the 160s. Resistance going to be all the way up to 174 to as much as 179 for Google. And then finally coming over to Microsoft, continues to sell off. We are seeing some, pretty aggressive selling pressure down 2%. RSI, MACD, L3 banker, oscillator, everything selling off with the resistance back up to as much as 432 and a very, very good support level and area of demand sitting right over here at around 398, sub $400 for Microsoft. So those right there are going to be some levels to keep in mind. Resistance at 430, got about a 6.5% upside potential all the way up to as much as 467 all-time highs. It's going to be a 15% all-time potential for Microsoft. And coming over to Netflix here. So NFLX, and Netflix here slowly and steadily continues to drift lower. As you can see, support level is going to stay put at $596, closer to $600 per share for Netflix, and a massive amount of resistance here inside this area of supply, and this red rectangle sitting between 635 and 652 for Netflix. Enphase here also selling off quite aggressively, down over 4%, back down to low 100s, and support level inside this green rectangle. We've also, very similar to PayPal, just been trading back and forth here in between that range. That support level is going to stay put at $94, $95, and a very, very strong, massive resistance at 138 to as much as 140 for Enphase as well. And finally, we come over to Costco, which is also just consolidating sideways. Resistance is going to be all the way up to 837. Support level down to as much as 786 for Costco as well. So hope you all enjoyed this video. I know it's a bit of a longer one, but there was a lot to unpack. Again, if you want to get access to this entire MoneyVest platform, including earnings, including all the other economic data, we're going to be adding a lot of other macro dashboard data points for you guys: volatility analysis, MoneyVest index, S&P 500 analysis, market snapshot, market concentration. Everything's going to be available with the link down below. This is the current status: NVIDIA, Tesla, Broadcom in a bear market, along with AMD, Qualcomm, Salesforce, Adobe, all of them in a bear market, with Oracle in a pullback, Netflix in a correction, Microsoft, Meta, Amazon, Google, all four in a correction right now, and Apple's the only one, along with Oracle, that's in a bit of a pullback at the moment. So hope you all enjoyed this video, found it helpful. Make sure that you drop a like and subscribe to the channel. Again, share this video with other family, friends. Share it on Discord, WhatsApp, Facebook, wherever you want to share it, so that more people can join us and join our community. Link down below with a 16% annual discount that's available for a limited time. Happy investing. I'll see you all in the next video.